Hi guys, I welcome you to my YouTube channel. So today we will learn how to prepare a cash flow statement for a given entity. Okay, so in accounting, the standards that provides for cash flow statement is IS 7, which requires entities to produce or to present a statement of cash flow as an integral part of its primary financial statement. That is alongside with the statement of financial position, income statement, statement of changes in equity, notes to the account, and the cash flow statement. So our focus today is on how we can prepare this cash flow statement. So the cash flows are classified and presented into operating activities that's prepared either using the direct or indirect method, investing activities, and the financing activities. Okay. So for the operating activities, our focus will be on the indirect method. All right, and this is the financial statement of a given entity that I went to the stock exchange to get. All right, so it's a manufacturing company, and this is the statement for the year ended 31st December 2018. So this is the asset section classified under non-current and current assets. Have equities and liabilities, the equity portion, the non-current liabilities, and the current liabilities. Also, we have the income statement, which comprises of the revenue, cost of sales, gross profit, and other uh, classifications on the income statement. All right. So we'll be preparing the cash flow statement for 2018. Note this section has already been prepared for 2017, so we want to update it for 2018 in line with the published account of this particular entity. So the key information to note while preparing a cash flow statement is that you must have a schedule of your fixed assets, that is your property, plant, and equipment. So this was extracted from the company's financials. And also have, if the company has intangibles, you also need to get information on the intangibles. Then there are some key notes in the account that you need to look out for in preparing the cash flow statement. So I've extracted those key notes that was used to prepare this particular financial statement. Then you have some additional workings to support the preparation of the cash flow statement. All right, so let's start without wasting much time on the cash flow statement for 2018. So the first, and I also included sources for which these numbers can be gotten. So to uh, make things easy for us while we prepare for our individual entities. So the first section we'll be looking at is the profit before tax. Okay, so the profit before tax is simply the profit before tax for the entity for the current year. So to get this, we say we need to come to our income statement. So on our income statement is found under the financial statements. So these are income statement, and this is the profit before tax for 2018. So we're going to pick this figure. Come to my cash flow. So equal to, I go and pick the profit before tax figure for the year. Okay, so this profit before tax figure has some cash and non-cash uh, amounts that has been added or subtracted from it. So we're going to adjust this amount back to account for, to take out non-cash income and non-cash expenses. So the first item we'll be looking at is the depreciation for the fixed assets, that's the property, plant, and equipment. Okay. So one source to get this information is on your fixed asset movement schedule, which is a necessary disclosure in your financial statement. So, and I have it extracted from the tangibles. So these are all the fixed assets for the particular company, and I want to get the adjust for the depreciation charge. So I'll come under the depreciation. So this is the depreciation section. Now I'll look for charge for the period. Okay. So this is charge for the period, and this is the total charge for the period, which is 2,331,358. Okay, and depreciation is usually deducted from your profit. So we're going to add it back. So 2,331,358. Come here, I'll put equals to 2,331,358. So I'm going to add it back. Okay, that's for depreciation. Then also amortization on intangible assets. So I can also get that from my intangibles schedule. Come to the amortization slash impairment. So I can see that the amortization for the year total is 177. 177. So I'm going to add it back as well because at the income statement it was deducted. So on the cash flow statement we're going to add it back. 177. 77. Okay. So the next is profits on disposal of items of PPE. So profits on disposal is usually found on other income for the entity. So it's not a major income line. So it's recorded as part of other income. So we click on our notes. So we can find it from the notes. So we'll come to notes on other income. So this is notes on other income, and I can see profit on disposal of assets, which is 8468. So I'll come on type 84. So note is a profit, which means that it was added to the profits. So in this case, we're going to be deducting it from profit because it's a non-cash transaction. So the amount is 8468. I'll say minus 8468. Okay. Then we have impairment of property, plant, and equipment. Impairment on property, plant, and equipment. So during the year, there was no impairment on property, plant, equipment. So we leave it at 0. Then provision for end of service benefit obligations. So this is gotten from employee benefits, which is found on the financial statement. So you can see a section for defined employee benefit liability. So there's a note for that on the financial statement. So we'll quickly go there and get the provision for end of year service. Okay. So come to our notes and look for the amount. Okay. All right. So this is the amount that we're having. Amount recognized as provision, which is based on the current service costs, interest on the defined benefit obligation, and interest income on the planned assets. So this entity has set aside money for as defined benefits for its employees, and also a planned assets to fund these liabilities, and this liability has generated a current service cost, which is for the services performed for the year. This is the cost attributed to it, and for the uh, asset for the liability, this is the interest expense on it, and for the planned asset, this is the interest income. So net amount is 37349. Okay, 37349. So note this was deducted from profits. We're going to add it back because the net position is an expense. Okay, the net position is an expense because the liabilities outweighs the benefits that it gets from the planned assets. So it's a net expense. So initially in the income statement it was deducted. So but in our cash flow statement, we're going to add it back to profit before tax, which is 317349. 317349. So next thing to update is the allowance for impairment on receivables. So we can find this information on the notes to the account. Okay, so on the notes to the account, we have allowance for on trade and other receivables. So we have two sections: allowance impairment, which was initially deducted, and the reversal of allowance, which was initially added. Okay, so for the allowance charge, which was initially deducted, we're going to add it back to the cash flow statement. The amount is 80,865. Okay, 80,865. Then the reversal that was initially added to the income statement, we're going to deduct it, which is 88 minus 88. Okay, so the last one under adjustment is the gain on remeasurement of identifiable assets. So we come to our other income. on the notes to get the information. So these are other income: gain on remeasurement of identifiable assets. So this was as a result of an acquisition or a merger, and the assets of the fixed assets of the company that's been merged with was revalued, and the gain on the revaluation, sorry, on the gain of the remeasurement of the net identifiable assets was recognized as part of other income, and this was added to profit. So for the cash flow statement, we're going to deduct it, which is 182,656 minus 182,656. All right, so this is a sum of the total adjustment. All right, so the next is to adjust for working capital in terms of changes in trade and other receivables, increase in inventories, increase in trade and other payables, increase or decrease in provisions. So we can get this from our workings, okay? So the first one is trade and other receivables. So the major thing to watch out is to find the difference between the current year balance and the prior year balance, then adjust for any impairments on the balance, okay? So for the trade and other receivables, so we'll pick this from the 2018 balance minus the 2070 balance. So this is the net position movement. But again, the amount was, there was impairment allowance charged on the assets. So we need to adjust for the impairment allowance on this particular asset. So there's an impairment allowance of 86, which we've already captured, and the reversal. So we're going to add this back and reverse this back. So we have a net movement of 145,127. Okay, so are we going to add it to our cash flow or deduct it from our cash flow? So the bottom line to note when making this decision is that if your asset is, if your the current year asset balance is more than the prior year asset balance, it means that you have prevented cash from coming in. Instead of having assets in cash, you are storing them up as other assets, which means there's a cash outflow for that particular account balance. And in this case, since our current year balance is positive, it means that there's a cash outflow of 1.451,127. Okay, so we're going to deduct this from the cash flow statement. So my cash flow statement, I come equal to negative workings. All right, so for increase in inventories, same thing applies. If the current year balance is higher, we're going to deduct it as well. So in this case, the current year balance is higher than, which means our cash is being stored up as inventories rather than as cash. So it's a decrease in cash flow for that particular year. So we're going to take the negative of that movement equals to minus this. Then we have increase in trade and other payables. So let's see what we have. Trade and other payables. So the current year balance less the prior year balance. Know that if the current year balance is higher than the prior year balance, it means that the entity has stored cash for its use rather than paying it out, which means that as the balance is higher, there's an increase in the cash flow for that particular company. So this is be a positive cash flow adjustment for the year. Okay, so what we do is to come pick the amount, which is the difference between prior year and current year. Okay, so also for the provisions balance, so the difference between the current year balance and the prior year balance. So since the payment that was made in the current year was less than what is in the current year, so the payment made in the prior year balance is less than what it is less than what it is in the current year, means that the entity has stored cash for itself. So the 9,600 will be a positive adjustment to the cash flow. Okay, so equal to workings. All right, so these are cash generated from operations, which is 5.32 million. All right, so the next thing is to adjust for benefits paid during the year on the employee benefit liability then contribution, if any, from the employer, and the tax paid on their tax liabilities. So you can also find this information on the notes to the accounts. So the first is the benefit paid during the year. So we can come to the notes to get that information. Benefit paid during the year. So we can scroll to the benefits. Okay. So you can see the section on the employee benefit liability. Yeah, statement of financial position, opening balance, the net cost required, recognized in P&L, which was already captured. Then the benefits paid by the employer during the year. So this is 174,254. So it's a cash outflow. So we're going to recognize the amount as a negative amount in the cash flow statement, 174,254. Minus 174,254. Okay. Then is there any contribution made by the employer during the year? Based on the notes, there is no contribution made by the employer during the year. So this is a zero balance. This is zero. Then tax paid during the year. So come to our tax section to get the amount of tax paid during the year. Okay, income tax payable. So from here, we can see the payment that was made during the year. So there's an income tax of 234,000 and 98,000. So the summation of the two is the total tax that was paid during the year. So I can say equals to 234,678 plus 98,908. So this is our tax paid during the year. So I can adjust it as a negative, which is a cash outflow because of the cash payment. All right. So in all, this is our net cash flow from operating activities. Like I told you that the cash flow statement is made up of three sections: the operating activities, financing and investing activities, and the financing activities. So we've successfully completed the operating activities using the indirect method. So to populate the investing activities, we have just two sections here to produce, which is the purchase of items of PPE and the proceeds from disposal. Remember, we had a profit on disposal of items of PPE. So let's see how much actual cash was received. So for the first one, which is the purchase of items of PPE, we can easily get that amount spent on fixed asset from the fixed asset schedule. Okay. Remember, initially we picked the depreciation from depreciation section. So for additions, we'll be picking it from the cost. So the total additions for the year, it's around 5,518,466. Okay. So I'll say 5,518,466. Okay, so I can easily pick this as cash paid for acquisition of items of PPE. So it's a negative cash flow. I'll say equal to minus, come and pick the amount. All right, then for proceeds for disposal of items of PPE. So it's gotten from our workings, which I already have here. So note that the cost for disposal and the accumulated from disposal can be gotten from the fixed asset schedule. Like the cost is 98,812. So under the cost, you come to disposals and you see 98,812, okay, as the cost of items disposed. Then for accumulated depreciation on the items disposed, you come to the depreciation section, you see disposals and you see 85,325. All right. So which is what we have here, the cost and the accumulated on items that were disposed. And note that this is the net of the two, which is the net book value, NBV. Okay. Note that we had a gain on our disposal, which was gotten from other income, 8464. So we add the gain back to the NBV to give us the cash that was received on the disposal. Okay. So that's how you get the cash received on disposal of item of PPE. So this is a positive cash flow on the cash flow statement. So I'll come here to pick it equal to, pick the amount, 21,000. All right, so we've populated our net cash flow used in investing activities. The last section we'll be looking at is the cash flow from financing activities. So the two sections we have here, it's dividend that was paid during the year and repayment of borrowings or proceeds from loans that was taken during the year, if any. So in the case of this entity, there was no additional loan that was taken, rather a repayment of outstanding loans were made. So let's populate based on this information. So for dividend paid during the year, you can find this information on the notes and also statement of changes in equity. So, but we have the information on the notes already, which is item. Okay, so can get it from our retained earnings. Note that dividends are paid from retained earnings, and this is a negative cash outflow. So I can just type it here, minus that's 1,578.47. Okay, so this is the amount of dividend that was paid to equity holders for the year ended. So we can then adjust this in our cash flow statement as a negative cash flow or as a cash outflow. Okay, so we have this as dividend paid during the year. Then was there any repayment of loans or borrowings? We also check from our notes. So from our notes, we will see that under loan repayment, earnings, yeah, borrowings. So you can see that there was no additional borrowing, so it won't be impacting on our cash flow. Rather, there was a repayment of borrowings, which is 3,87313. All right, so this would be an outflow in the cash flow statement. So I'll come here equal to minus notes, pick this. All right. Okay, so this is the net cash flows used in financing activities. All right. So our net increase in or decrease in cash flow statement is 2.639. Okay, which is the addition of the cash flow, net cash flows from operating activities, investing activities, and financing activities. Okay. And the cash and cash equivalent as at 1st of January 2018 is the brought forward from 2017. Okay, this is simply the brought forward from 2017. So I can decide to color to signify that it's just a movement. All right. So note that the net increase or decrease in cash and cash equivalent is the movement between the cash and cash equivalent for the year. Okay, so I can say equal to this minus this. Note we are having 2.537, and here we are having 2.639811. Let me bring it down. Okay, and let me bring the movement from the financial statement. Okay. So the movement between these two is, sorry, equals to this minus this is 102,052. So 102,052 represents a bank overdraft that was taken by the company during the year. So you can see that in our notes. In our notes, where we have the cash and notes on cash and cash equivalents. So this is the bank balance or the cash and cash equivalent balance, which is 595,905, which is what we have on the income on the statement of financial position. But the amount was adjusted with bank overdraft that was taken during the year. So the net cash and cash equivalent position, it's now 493,854, which is the same amount that we have as balance on our cash and cash equivalent. So this amount is checked against the workings or the notes on cash and cash equivalent. So this, with this, it shows that our cash flow statement is correct. Okay.